Hey everybody, it's Justin with Confident Options, and tonight we're going to review trades closed on Tuesday, July 31st, 2018, the final day of July. Hard to believe it, we're already into August. We had 3 closing trades yesterday, 2 earnings trades, and 1 strangle, pretty standard, longer duration Facebook trade. All were good trades for us. So let's start at the top. RIG Transocean was reporting earnings going into the close, and so we ended up taking the straddle just because it's a lower price stock. So we sold the 1350 calls and puts. If we look over at our research, and what we looked at on the 30th was RIG, RRC, and PG. We'll go through the others, but starting with RIG, their expected move was just about 60 cents, which represented about 4.3% move in the stock. The one standard deviation move of all past earnings events was almost 4%. So it was pricing over in that. So we know that that's our edge in the trade. We're able to get out wider than the majority of the previous moves. And so looking at the chart on this one, go over to RIG. Couple things to note on this one. So this is the day before earnings. So it closed, let's see, it closed down here at 12.89. The next day, actually, excuse me, this is the day before earnings. So it closed up here, actually, 13.37, and then it opened at 13, I think it was 13.27. It was a 10-cent move when, again, the expected move was 60 cents. And we ended up selling the 13.50. It kind of sold off on us at the end of the day there, but we ended up selling the 13.50 calls and puts. So right in this level, sorry about that, right in this level here. And so what happened was there was not enough implied volatility to begin with. So see how low this is right here, 13%. It's just not enough. If the stock was up here, around 30%, there may have been some meat on the bone for us to capture. There just wasn't any. So even though we opened up in the range, we didn't get the IV crush that we wanted to because there wasn't enough IV in it to begin with. And so we ended up just making this a scratch trade. What we ended up doing was buying it back for 65 cents. So we collected a premium of 66 cents and bought it back for 65. We basically just paid for the commissions on this, and we'll call it a scratch trade and move on. Next earnings trade was PG, Procter & Gamble. So on PG, they were pricing in a move about 2.5%, which represented a $2 move in the stock. As you can see, all past earnings events, this 2 standard deviation of all those events was under 2%. So this was a huge advantage for us. We're able to get much wider than even 95% of all past events, which is fantastic. That's exactly where we want to be. I wish they could all be like this. It just doesn't happen that way. So we have to be super selective when we're taking these and looking at these trades, just because we know that they can make some monster moves like Facebook and Netflix did that can really, really destroy your accounts. You got to be careful when you're looking at these. So earnings was reported after this was the close before earnings. So it closed here at 80.16 and it opened at 80.40. So the expected move again was $2. We were priced in at 82.50. So we were up here at 80, all the way up here, way over here. So all the way up here. And then we were also priced in at 77.50. So again, all the way down here. So we had a ton of room for this thing to move. We could get really wide. This stock doesn't jump a lot, and so it was an awesome trade for us. Again, the calls are up here and the puts are down here, just to be clear. And so what ended up happening is that since it opened pretty much in the middle of the range, we wanted to close both sides just to kind of remove all the risk if it were to make a big move one way or another. So we just removed both sides, and we ended up removing both sides for 34 cents. So going back to the website here, we can take a look at the strikes and the premiums. So we ended up collecting 55 cents on the opening of the trade, and we closed it out for 34 cents. So it represents a capital or a premium crush of about 39% and return on capital of 1.5%. Again, it's a naked trade, so it's a strangle, meaning undefined risk. So that means there's more capital that you have to put up in the first place. So you can think of this, you can scale this. If you did 4 contracts, you'd be over about $5,000 for the trade, and you would have returned just under $100 in the trade. So great return on capital just overnight, and we get in and we get out. These trades keep us engaged. That's why we like them a lot, and they're a big part of our strategy at Confident Options. The final trade that we'll review is Facebook. The interesting thing that happened on Facebook, everybody knows that they got crushed, right? I mean, insane move, way outside the expected range. We did not trade the earnings event just because the pricing wasn't in our favor. But we noticed that after the big gap, so here is the night before earnings, here's the open after earnings, we noticed that even the day after earnings, usually we expect the IV to crush right after earnings. What happened is it stayed high. It actually elevated from the day before to the day after just because of the big move down. So what we ended up doing was opening a strangle the day after earnings were reported. And so actually the day of earnings reported, so they reported that on the 26th. And so what we ended up doing was getting nice and wide on this. So 205 calls, so way up here. And what were we at? 155 puts, way down here. So obviously it was skewed a little bit. We had a little more room to the upside. That was getting priced in. This big move down was getting priced in for the move back up. But it gave us a ton of room, and we were able to sell that sucker for almost $3.50. So actually, technically, our break-evens were even $3 further out than the strikes. And so we had a huge range on this to profit. And what ended up happening was that IV finally ended up crushing. So it happened after the event, which is unusual, but you can see this move down. So it was up here at like 75 and it went down to under 40, under 50. So a good crush in earnings, which allowed us to get this in IV, which allowed us to get this off really quickly, 5 trading days, which is highly unusual, which is why we took it off before our profit target. When you get that big of an IV move, you kind of want to capitalize and lock in your gains. So again, sold the 205, the 155 strangle, which is the calls and the puts, for $342. Bought it back for just about $2, which represents 40% premium capture. And we were able to return about 7.75% on our capital. So that represents, for one contract, $137 with only having to put up under $2,000. So if you scaled that to a $10,000 position, which is about 8 times or 7 times what we put on, so 7 contracts, you can see it'd be about $800 trade in Facebook. So that's the last trade we wanted to cover today. You can go to the website and see all the other trades that we ended up closing today, and any other trades, and then we'll get this video posted here. Again, you can see our new performance metric for earnings, specifically for earnings trades, which is our July performance. So earnings are a big part of our strategy and portfolio, and this graph represents every single earnings trade we took in July. You can see the ticker symbols at the bottom, and then you can see what a one contract P&L would be. So you just scale it from here, right? We had 3 losers, 2 scratch, Pep and Rig, and the rest were winners. And so this represents about 85% win rate. And you can see, I think if you traded one contract on everything, your max margin draw was like $3,000 and your total return was about $500. And so doing those percentages, if you only traded one strangle or one straddle, depending on the strategy we used, on each of these you would have returned about 6% on your capital that you put to risk. So the max you put to risk at any time was $3,000. So great consistent strategy for us. We love earnings trades. They all don't go this way. All months don't go this way, and that's just part of the game. But when you win more than you lose and you manage those losers in the correct way, you end up being profitable in the long run. So that's the ultimate goal. Again, we always want to simplify as much as we can these concepts, so everybody can use these concepts. It only takes about 30 minutes in the morning and 30 minutes at night. You're not sitting and staring at the screen. So that's why we absolutely love options and the levers that they give us. If you have any questions, drop a comment in the on the closed trade tab. There's a box at the bottom to submit questions. Of course, follow us on Instagram at Confident Options Trading, and hope you guys have a great night. We'll talk to you later.